The US Federal Reserve cut interest rates again this time, meaning interest on loans, mortgage, etc. gets cheaper, but the interest you get from banks on your savings also decreases. Usually, a rate cut is seen as a positive sign, but this time it comes with a cautionary note. Our next report tells you why.
The U.S. Federal Reserve has made headlines this week by cutting interest rates for the third straight time this year. The Fed lowered its benchmark rate by 1/4 percentage point, bringing it to between 3.50 and 3.75%, the lowest level in nearly 3 years. This move aims to address growing risks in the labor market, even as inflation remains persistently above the Fed's target. For everyday Americans, this rate cut has mixed implications. On one hand, borrowers stand to benefit. Lower rates often translate into cheaper loans, from mortgages and auto loans to credit cards. But there's another side to the story. For savers, this environment is far less friendly. The drop in interest rates means that returns on savings accounts, certificates of deposit, and other fixed income investments will decline. The stock market has reacted mostly positively to the Fed's decision, viewing the rate cut as a supportive step for corporate earnings and economic expansion. Lower borrowing costs generally encourage businesses to invest and hire. However, some analysts caution that while the market may cheer today, underlying economic conditions remain fragile. Within the Federal Reserve itself, opinions on the rate cut were divided. 3 officials voted against the 1/4 point reduction, a sign of internal debate. Some members expressed concern that cutting rates at this stage might reduce the Fed's ammunition for fighting future downturns. They worry about what economists call a jobless expansion, where the economy's growth does not translate into meaningful employment gains, weakening the labor market's role as a buffer against recessions. Looking ahead to 2026, the Fed projects modest GDP growth and slightly eased inflation expectations, but unemployment rates are forecasted to stay steady, signs the economy is in a delicate balance. Policymakers expect at least one more rate cut next year, but plan to move carefully, monitoring how past reductions impact growth and inflation. Adding complexity to the Fed's path are changes in its leadership. With Chair Jerome Powell's term ending in May, several new candidates are under consideration, including President Trump's economic advisor and former Fed officials. Their approach to monetary policy could influence how aggressively or cautiously the Fed acts in 2026. Finally, there's a political backdrop too. The Fed's independence has been tested in recent months, with efforts to change top leadership fueling uncertainty. Economic data releases have also faced delays due to extended government shutdowns, making it harder for the Fed to get a precise read on the economy.
If you like this video, then like, share and subscribe to ET Now.